Honorable Speaker, we are not convinced that we are ready to tax funds at the point of activation. We strongly feel that it is important to establish a framework to make sure that we have the correct softwares installed by sharing data with telcos, by making sure that Communications Authority is ready, Honorable Speaker, to charge taxation on activation. But, Honorable Speaker, with the current framework, the National Treasury is recommending that we change the effective date of this to 1st of January 2027. But however, Honorable Speaker, this Parliament lives and can sit at any particular time. And therefore, Honorable Speaker, even as we continue to engage with the National Treasury and wait for the Committee of the Whole House tomorrow, Honorable Speaker, I would urge that we shelve aside that particular idea until we have correct systems in order so that we do not burden Kenyans, Honorable Speaker, with additional taxation or unpredictability in terms of taxation. Because, for example, Honorable Speaker, then what will happen if I go and buy a phone from a dealer and I'm not aware whether taxes have been paid, and I send that phone to my brother in the village or to my grandmother in the village, only for my mother to be told that you cannot use your phone because your phone has not paid the requisite taxes. So, Honorable Speaker, I think it's very, very important that we rethink this particular proposal and ensure that there is no revenue loss, there is no extra burden to Kenyans. And Honorable Speaker, even I say this, I know we have had an extensive discussion, even including now with the CS and the PS, and I urge them that it's a good idea. Yes, it has a good deal, but we need to reconsider at what point should this tax be paid, Honorable Speaker. The bill is seeking on the issue of, Honorable Speaker, the bill is seeking to address an existing ban on taxation on Clause 2B of income arising from card-based transactions. Currently, such fees are not classified as management or professional fees and therefore are not subject to withholding tax under Section 35 of the Income Tax Act. And therefore, the committee, Honorable Speaker, will be proposing further amendments to this particular clause to make sure that we are in line with the national standards, there is no revenue loss. And Honorable Speaker, then we also don't make transactions expensive in our digital inclusion space, Honorable Speaker. Clause 2E is proposing to amend provisions relating to betting and gaming by expanding the definition of withdrawals. Honorable Speaker, the proposal is seeking to ensure that there is uniform application of withholding tax across different forms of betting and gaming transactions. The bill further proposes to reintroduce the definition of winnings and reinstate withholding tax at 20%. The committee observed that frequent changes on definitions applicable to winnings and withdrawals have created uncertainty for operators and affected predictability within the gaming and betting tax. And therefore, although it is very important to levy this sin tax, Honorable Speaker, it is important that they align with the best practice. It is in line that it is still predictable, and we must make sure that also we make it easy to pay tax rather than the temptation to have members of the public or these particular entities evade tax, Honorable Speaker. Clause 3 borrows proposes to narrow the tax exemption applicable to gratuity and similar payments by employers and remitted to registered pension schemes by introducing additional eligibility requirements. Currently, Honorable Speaker, currently such payments made on before 1st of July 2025 qualify for exemption regardless of the duration and continuity of the employee services. The committee observed that this broad exemption may be susceptible to abuse through tax administration arrangements, particularly where remuneration is structured as gratuity and a short-term contract, Honorable Speaker. So by extending the time, Honorable Speaker, the risk of exempting all gratuity paid to employees, Honorable Speaker, from income tax could mean that an employer would choose to pay their employees gratuity rather than pay them a salary, Honorable Speaker, and that would lead to very huge tax loss, Honorable Speaker. Clause 4 is proposing to introduce a simplified tax framework for non-residents earning rental income from properties situated in Kenya. And so, Honorable Speaker, it's important that I emphasize this point. There has been a lot of public debate that there has been increase in taxation of rent income, Honorable Speaker. But far from the truth, Honorable Speaker, what this proposal is seeking to do, as contained currently in the Income Tax Act, tenants are required to withhold 30% of the rent they pay to non-residents, Honorable Speaker. And we realize that, Honorable Speaker, it is difficult for a taxpayer or for a tenant to verify whether the landlord is a resident or is a non-resident. And therefore, this proposal is now seeking to provide clarity to that and make the rate of rental income tax for non-resident to be at 30% and that will be a final tax, Honorable Speaker. So it simplifies taxation for these non-resident landlords, Honorable Speaker. It takes away the burden from the tenants back to the landlord, Honorable Speaker, and therefore that clarifies that particular system. So it's important that I mention there has not been any proposed change in taxation on resident rental income. So if you're paying rent or you're a landlord, there is no change in taxation as a resident institution, Honorable Speaker, on either the tenant or the landlord. Honorable Speaker, Clause 7 is proposing to introduce a 1.5% withholding tax on payments made on sale of scrap metal by treating such payments as income subject to withholding tax. Currently, income from sale of scrap metal is not subject to withholding tax, and that's creating an inconsistency in the treatment of income earned from different sources. The committee observed that the repeal of the previous withholding tax regime created compliance gap in the large informal cash-based sector characterized by limiting record keeping. Honorable Speaker, it's very important to mention that sale of scrap metal, Honorable Speaker, has led to a lot of vandalism being done on public infrastructure, and also has created untraceability on who is a buyer and who is a seller of this particular segment. And so introducing a 1.5 withholding tax will therefore mean that everyone dealing in scrap metal, Honorable Speaker, will therefore be that information will be available to the authority, Honorable Speaker, and become easy for them to be traced, Honorable Speaker. Clause 8 is proposing to simplify the taxation of trust by replacing the existing provisions under Section 11 of the Income Tax Act with a clearer framework under which trust income is taxed at the trust level and not subjected to further taxation upon distribution to beneficiaries. Honorable Speaker, again, this is going to make it easy for establishment that has a trust fund, Honorable Speaker, to distribute in terms of how they pay their taxes by making them by the trust income being taxed at the trust level and not being taxed, Honorable Speaker, at the point of distribution to beneficiaries. Clause 10, Honorable Speaker, is proposed, and it's important to mention the reason why this proposal is there, Honorable Speaker, because this income that is being transferred to trust fund, Honorable Speaker, has already been taxed under the Income Tax Act, Honorable Speaker. Clause 10 is proposing to amend the Act to allow employees of CBK to claim a deduction for interest paid on mortgage loans, subject to the limits provided under the law when determining taxable income, Honorable Speaker. The proposal seeks to extend mortgage interest relief to central bank employees in line with the treatment applicable to other taxpayers. However, Honorable Speaker, so if you check the Income Tax Act, Honorable Speaker, on the 4th schedule, it provides for provision of mortgage relief for employees that take mortgages from financial institutions, from insurance funds, Honorable Speaker. However, because central bank is a regulator, Honorable Speaker, central bank is not listed on the 4th schedule of the Income Tax Act, and therefore, employees of Central Bank of Kenya, when they take their mortgages from their employer, which is the central bank, then they're not given mortgage relief as if they were working in a different bank, Honorable Speaker. However, Honorable Speaker, the committee observed that if we grant this exemption to central bank employees, Honorable Speaker, it could be deemed to be discriminatory, Honorable Speaker, because other entities, whether it is, for example, Parliamentary Service Commission, where ourselves and members of our staff take our loans or our mortgages from Parliamentary Service Commission fund, then we do not qualify, or they do not qualify for mortgage relief, Honorable Speaker. And therefore, just providing an exemption just for central bank employees, Honorable Speaker, could be deemed as being discriminatory, Honorable Speaker. In any case, Honorable Speaker, even employees that take mortgages from SACCOs, for example, they are not subject to mortgage relief, Honorable Speaker. And therefore, the committee recommends deletion of this particular proposal, Honorable Speaker. Clause 16 is proposing to amend Section 24(1) of the Income Tax Act by introducing a minimum deemed dividend distribution threshold of 60% of undistributed income. Under the proposal, where profits are not distributed within 12 months after the end of the accounting period, a portion of the undistributed income may be deemed to have been distributed as dividends for tax purposes. The proposal is seeking to provide certainty and consistency in the application of deemed dividend provisions and discourage the indefinite retention of profits solely for purposes of deferring dividend taxation. During our stakeholders engagement, the Association of Chartered Certified Accountants of Eastern Africa, the Institute of Certified Public Accountants of Kenya, PwC, Mr. Julian Amboko, among others, raised concerns regarding the proposed 60% threshold, noting that it may negatively affect businesses by limiting their ability to retain earnings for operational cash flows, expansion, and growth. ACCA further observed that many businesses retain profits for genuine commercial reasons, and that imposing such a threshold could create cash flow constraints, particularly for small businesses that may face challenges in accessing alternative financing. The association therefore proposed reducing the threshold to 30% to balance revenue objectives and business sustainability. The committee therefore observed that where the proposal addresses concerns relating to tax deferral, a 60% deemed distribution requirement could place undue pressure in businesses and constrain investment decisions. The committee therefore is proposing to moderate the threshold to a maximum of 40% to achieve a balance between enhancing revenue 40%, to achieve a balance between revenue collection and allowing businesses sufficient flexibility to retain earnings for growth and investment. Honorable Speaker, the issue of taxation of deemed dividend, Honorable Speaker, when a business declares a profit and has to distribute dividends to their shareholders, Honorable Speaker, those dividends are subject to dividend tax, Honorable Speaker. However, there is a temptation by many businesses to continuously underdeclare their dividends, or not underdeclare, not to distribute their dividend, Honorable Speaker, to avoid paying dividend tax, Honorable Speaker. And therefore, it is important that we discourage these particular entities for that particular issue of tax planning, Honorable Speaker, but still allow directors the flexibility to exercise their fiduciary power as contained, Honorable Speaker, in the Companies Act that has a whole policy on dividend distribution. So to balance the two, the committee disagrees with National Treasury on the minimum threshold of 60% and proposes a different threshold of 40%, Honorable Speaker. Clause 18 and 19 is proposing to revise the timelines for filing individual income tax returns by introducing different filing-based periods based on the nature of the return, Honorable Speaker. Under the proposal, taxpayers with nil returns would be required to file within the first month following the end of the year of income, while taxpayers who have already paid tax, such as persons earning employment income, would be required to file within the fourth month. Currently, all individual income tax returns are due by 30th of June each year, regardless of the nature of return. The committee observed that although the proposal seeks to promote timely files, differentiated timelines should be adjusted to provide individuals with 4 months and corporates within 6 months to file their returns, Honorable Speaker. The committee noted that nil returns require minimum information and processing, while corporate returns involve more detailed financial records and compliance procedures. We therefore recommend that we only have 2 timelines. One, 4 months for individual taxpayers, and within 6 months, Honorable Speaker, for corporate, Honorable Speaker. And this is also to prevent all the hassles and the bustles that go around just before the end of a financial year, before 30th of June, where now all the taxpayers, whether they are commercial, whether they are corporate taxpayers or individual corporate or individual taxpayers, are required, Honorable Speaker, to file their returns, Honorable Speaker. Clause 22, Honorable Speaker, is proposing to remove the preferential 5% withholding tax rate applicable to dividends paid to East African citizens. The committee observed that this preferential rate creates an equal tax treatment based on residency, undermines equity within the tax system, and provides a tax incentive that is not clearly linked to economic performance, which results in revenue loss. The committee therefore notes that the proposal aligns with the national tax policy objectives of rationalizing tax expenditures, promoting a fair, efficient, and neutral tax system, and therefore supported the proposals as it enhances consistency in the tax framework and promotes equitable treatment of taxpayers. Honorable Speaker, Clause 31 and 32 is seeking to reclassify certain supplies from being zero-rated to exempt status. After further scrutiny, Honorable Speaker, we have the proposal that to move from first schedule to second schedule. That means from exempt from zero to exempt, Honorable Speaker. Locally assembled and manufactured mobile phones, electric buses, motorcycles, and electric bicycles, lithium, ion, and solar batteries, transformation of sugarcane farms to milling factories, input on raw materials locally purchased or imported for manufacture of feeds, and inputs of raw materials locally purchased or imported for manufacture of pharmaceutical. Honorable Speaker. Honorable Speaker, the committee knows that although they understand the National Treasury's criteria of trying to reduce tax expenditure, Honorable Speaker, it is important that we continue to have a predictable tax environment. We need to have to ensure that we promote our exports, Honorable Speaker, because as you are aware, Honorable Speaker, zero-rated products a manufacturer is allowed to claim their input tax, Honorable Speaker. And so then the reason is, and what the committee will be proposing to this House, Honorable Speaker, tomorrow is where we feel that there is a need to continue to have this either exempt or zero status, Honorable Speaker. It is important then if you make a decision to make the products exempt, then we also exempt the raw materials. So we move now so that we have exempt raw materials and exempt finished products, Honorable Speaker. Clause 33 is proposing to simplify the VAT treatment on worn clothing and worn footwear, Honorable Speaker. Honorable Speaker, this is also a matter that was highly debated, and I want to thank the stakeholders that appeared before us, including the Mitumba Consortium Association of Kenya, that is represented by Apostle Teresia Werimo, Honorable Speaker. As we speak, if you import, Honorable Speaker, Mitumba, and Mitumba could be clothes or footwear, Honorable Speaker, or bags, Honorable Speaker, then they are required to pay 16% VAT, and they are also required, Honorable Speaker, to pay 30% income tax of their income, of the profit that they make, Honorable Speaker. However, this has become very problematic to traders in this particular sector, because most of the people that will sell Mutumba, whether it is our Mitumba people in Gikomba, or the one in Nakuru, or the one in Molo, or the ones that sell Mitumba across the country, Honorable Speaker, if you subject them to reporting for VAT or to paying value added, Honorable Speaker, it has become problematic. It has created, Honorable Speaker, as I was saying, a form of rent seeking, Honorable Speaker, by members of the Kenya Revenue Authority. Most of those traders are not able to get tax compliance, and therefore they recommended a simplified tax system where they only pay, Honorable Speaker, 5%, they pay 30% of their deemed profits, Honorable Speaker, which would translate to around 15%, Honorable Speaker, of their profits, which becomes a final tax, Honorable Speaker. And therefore, we agree with the National Treasury that this is a better plan. We're going to lead to more collection. It's going to simplify how our Mitumba pay taxes, Honorable Speaker, and also lead to enhanced tax compliance by the taxpayers, Honorable Speaker. Clause 4 and 5 is proposing to simplify the taxation framework applicable to mobile phones. Honorable Speaker, I did speak to that particular matter. We agree that taxing mobile phones on activation would be a better plan to ensure tax compliance, Honorable Speaker. But we need to phase out the date of implementation of this particular clause, Honorable Speaker, if this Honorable House has to agree with us, Honorable Speaker. But however, we need to have preparedness, including our systems, as I said, to make sure that it doesn't bring an extra tax burden, Honorable Speaker, to the users of our mobile phones, where our mobile phones are used by students who are studying at home or at the universities. It is being used to create content, Honorable Speaker, and therefore it's very important that we still enhance a simplified and predictable tax environment, Honorable Speaker, for this very good sector, Honorable Speaker. Clause 38 is proposing to amend the Tax Procedures Act by introducing provisions relating to crypto asset reporting framework and reporting virtual asset service providers to submit annual information returns to KRA on crypto asset transactions, Honorable Speaker. The proposal further provides a framework for Kenya to enter into automatic exchange information arrangements with foreign jurisdictions in line with international transparency standards. In addition, the bill is proposing to correct the reference to persons who charges fees on virtual asset transactions by replacing virtual asset providers with virtual asset service providers. The Finance Act, Honorable Speaker, of 2025 introduced excise duty on fees charged on virtual asset transactions, but incorrectly used the term virtual asset providers instead of virtual asset service providers, as recognized under the Virtual Assets Providers Act of 2025, that this Honorable House, Honorable Speaker, passed last year. This amendment is seeking to align the Excise Duty Act with the correct statutory terminology, enhance clarity, and support effective implementation of tax on virtual asset transactions. During stakeholder engagement, Honorable Speaker, Mr. Mabuti Mutua of Lexin Consulting Limited supported Kenya's move towards a national tax cooperation and transparency, but raised concerns regarding the need for adequate safeguards in the implementation of crypto asset reporting framework. He observed that the proposed provisions would expressly align with Article 24 and 31 of the Constitution of Kenya and Data Protection Act to ensure that the collection and exchange of crypto asset information respects taxation's privacy. Mr. Mutua recommended that reporting obligations be limited to information that is necessary, relevant, and proportionate, and consistent with the principles of data minimization and purpose limitation. This committee agrees with the state stakeholder and will therefore be proposing amendments at the Committee of the Whole House tomorrow when this Honorable House will be seeking to do the Committee of the Whole House. Honorable Speaker, Clause 41 is proposing to empower the Commissioner to issue tax assessments where available information indicates that a taxpayer has not fully declared or paid the tax due. The provision is anchored on Kenya's self-assessment system, under which taxpayers declare their own income and tax liabilities. However, the Commissioner may also rely on information obtained from third-party sources, electronic tax systems, financial records, customs data, and other lawful sources which may indicate discrepancies in declared tax provisions. The committee observed that while the proposal strengthens tax administration by enabling data-driven and system-generated systems, it is necessary to provide adequate procedure safeguards to protect taxpayers' rights. The committee therefore recommended the introduction of Section 29A to the Clause 29A to the Tax Procedures Act, requiring that the Commissioner must disclose the information sources and computations relied upon in making an assessment. The committee further recommends that such disclosure be a condition for the validity of assessment. And in that case, in case of a dispute, the Commissioner bears the burden of demonstrating the accuracy and reliability of information used, Honorable Speaker. Honorable Speaker, it's very important that I speak to this, I give more context to this matter, Honorable Speaker. Because Clause 41 is providing for powers to the Commissioner to use other sources of third-party data to do a tax assessment on a taxpayer, Honorable Speaker. That would mean they could rely on information, whether it is from whichever source, Honorable Speaker. And Honorable Speaker, although they already have access to that information, Honorable Speaker, because of information sharing, and of course the use now of e-TIMS and requirement that all invoices that are allowable have been issued through the e-TIMS system, Honorable Speaker, giving the Commissioner the absolute right to do an assessment on you without giving the taxpayer the source of that information would be against principles, Honorable Speaker, of justice, Honorable Speaker. It is important that in international best practice that you allowed, Honorable Speaker, to know the source of information that, Honorable Speaker, you are being accused of, and not having that burden on the taxpayer. The burden of, it's called the principle of burden of proof, Honorable Speaker, should be on the Commissioner and not on the taxpayer. A taxpayer should not be allowed to self-incriminate themselves in terms of their tax liabilities, Honorable Speaker. Clause 43 is proposing to introduce a one-year tax amnesty under the Tax Procedures Act, running from 1st of July 2026 to 30th of June 2027. The amnesty, Honorable Speaker, will apply to tax liabilities accrued up to 31st December 2025 and will allow taxpayers to regularize outstanding obligations by paying the principal tax due within the amnesty period. Upon fulfillment of the prescribed conditions, penalties, interest, and fines relating to the eligible tax debts will be waived. The proposal intends to provide a final time-bound opportunity for taxpayers to settle historic tax liabilities, enhance compliance, and improve revenue collection for outstanding tax, Honorable Speaker. So this particular tax proposal, Honorable Speaker, is expected when we had a tax amnesty in 2020.